Dear students, this is the 2013 August and September exam that I will be doing in this video, and as usual it is out of 70 marks. There is 70 marks and it's a 2-hour paper just like your 2016 exam. It says the owner of Pearl Daisy Traders provided the following pre-adjustment trial balance on the 31st of December 2012. It means 31st December is the end of the accounting period. And we are given the cost of the assets being equipment 200,000 rands and the cost of the vehicle being 550,000 rands, and respectively we are given their accumulated depreciation on the first day of the year. Take note of that. 1st January 2012 is 40,000 rands. That means this is an opening balance. This will be an opening balance, and we are also given another accumulated depreciation on the first day of the year 2012 being an opening balance. Then after we are given investment, fixed deposit investment at 10% being 185,000 rands. Remember, this can be a current asset or a non-current asset. It depends to the maturity date of the fixed deposit. If it matures in the next 12 months, it's a current asset. If it matures in more than 12-month coming period, therefore now it becomes a non-current asset. However, you'll see that in the adjustment. And to highlight another thing, we are given the allowance for credit losses on the 1st of January 2012. This was an estimation of credit losses that was done last year, and this amounted to 10,000 rands. And we are given insurance that was prepaid last year. So now this insurance was an asset last year because it was prepaid, but at the end of the current year the 7,000 must be cancelled from being a prepaid expense to an insurance expense account, because this is an expense for the current year. So now it must be added under the insurance expense for the current year. We are given inventory trading stock 185,000 rands. There's not much to explain. Bank capital, trade payables, sales, and above that we are given the interest on the fixed deposit. The interest on the fixed deposit is given to be 14,000 rands. Remember, there was a fixed deposit that amounted to 185,000 rands, and it is 10% interest. That means the company will receive 10% out of the 185,000 rands that they have invested. But we see in the trial balance that there was interest already received. Here is 14,000 rands that was already received. And remember that when you see incomes and expenses in the trial balance, it means the income was already received, is the amount that was actually received. And when you see expenses, it means it's expenses that were actually paid. So now in this case we have already received 14,000 rands, which is the interest on the investment, and it is on the credit side of the trial balance, indicating that it is an income. However, if we say 185,000 rands times by 10%, we get 18,500, and 18,500 is the interest that was supposed to be received, but we only received 14,000 rands. It means there is a difference between the two, and the difference will be an amount of 4,500. If we say 18,500, the amount that was supposed to be received, minus 14,000 that was already received, therefore now we are realizing that we received less amount of interest or income than we supposed to have received. Therefore now the difference of 4,500 will be recorded under trade and other receivables as accrued income, increasing our receivables. So let me just slowly continue with my transactions. Now after that we are given the notes or the additional information or adjustments that must still have to be taken into account. And I always recommend that before the student read the adjustments or the additional information, they must straight go to the requirements, so that after they read the requirements, they can immediately know what to do and how to strategize answering the exam, because exam definitely need a strategy to answer, because time is also a limiting factor. So now in the requirements, we are required to prepare the insurance expense ledger account, and 1.2 we are required to do the ledger account for the asset disposal. It means there was an asset that was disposed, and after we are required to do the accumulated depreciation on vehicle. So now if you are doing an accumulated depreciation on vehicle and there was an asset disposal, it means obviously, or there's a high probability that it's the motor vehicle that was disposed. And if a motor vehicle was disposed, I always recommend that students must also do the vehicle ledger account, although this is not required, but I'll just do it as my working. So now we can do the vehicles ledger account, then after we do accumulated depreciation, then we do after asset disposal, because the sequence for me is the ledger account for asset, then after we do accumulated, then after we do the asset disposal. So this is number one, this becomes number two, this becomes number three in terms of the sequence. Then after we are required under 1.3 to do the statement of profit and loss, which is income statement. Then after we are required to do under 1.4 the statement of changes in equity. Then 1.5 we are required to do the statement of financial position, which is sometimes called a balance sheet. Then under 1.6 we are required to do the property, plant and equipment note, where obviously we take into account note number A and note number B, obviously where there was a disposal of the asset. And if you see, this note does have a relationship with 1.2. This 1.2 does have a relationship with 1.6. So now when I answer this question paper, as I always say that a student needs a strategy on how to answer the exam. So now I will always prefer that we start with the ledger accounts. This will be number one. Then after my number two will be the property, plant and equipment note. Then when I'm done with the property, plant and equipment note, then I can do all my income statement, equity statement, then after I do the balance sheet. So I will structure the answering of this question paper in the manner that I start with 1.2, then I do 1.6, then I do all other requirements and complete all of them. So now very importantly, whenever we already know the requirements, it's very good that we structure all the requirements. We know that 1.1 was the insurance, and I just opened the ledger account for that. And 1.2 we were required to do the asset disposal ledger account and the accumulated depreciation on vehicle. I've also opened this ledger account for vehicles at cost because vehicles were sold. So now it's also good to have that, because we have to do the property, plant and equipment note. So we will need this information from this ledger account. Then very importantly is the template of the PPE note. Then now after we have done the ledger accounts, we just transfer that in the property, plant and equipment note. And normally the structure in the exam is given to students, but the details on the left hand side in this column, students have to know how to do that. Just the left hand side, this part, they must know how to do that. Then after I'm done with 1.6, then I will go straight to the income statement. And it's always recommended that students must draw the full structure of the income statement before they even attempt to answer the question or to go to the adjustments. So now I just recorded my revenue from sales, gross profit, and the interest on the investment, because in the trial balance I've seen that there is interest on the investment. Then after the interest on the investment, we were already given an amount in the trial balance. We can just open brackets here where we record the 14,000 of the interest on the investment. Then we will make an adjustment based on the information given. Then after we come to expenses, and when we come to expenses, I always also recommend that students must write the amounts as they are given in the trial balance. The 2,500, the 130,000 rands, and the 60,000 rands are the amount of the expenses that were already given in the trial balance with regard to credit loss, salaries and wages, and the rent expense. Let us just see that we have an amount of credit loss being 2,500. Write that amount as it is. Salaries and wages 130,000 rands, rent expense 60,000 rands, other operating expenses 485,000 rands, insurance 84,000 rands 500. So it's very good that you prepare the structure of the template and you write all the amounts. Other operating expenses is given to be 100 or 485,000 rands. Then I can write that as it is 485,000 rands. The reason why I write all these amounts here, I'm thinking that there might be an adjustment where I have to subtract or add based on the adjustments, but I already know that with regard to the other operating expenses, there is no adjustment to take into account. Then after we know that if there is no finance cost, and I have seen that in the trial balance there was no loan, and if there is no loan in the trial balance, it indicates that there is no interest on loan. The investment here is the investment being an income. So I did not make provision for the finance cost because there is no loan that the company had during the current year. So now I have the structure of my income statement with all the amounts that were already given. If you also want, you can open brackets and write revenue from sales, open bracket, write the amount, and together with the cost of sales. Then after I've also prepared the structure for the statement of changes in equity. Then lastly, I have the structure for the statement of financial position. And if you see there under my property, plant and equipment, this amount will come from the PPE under 1.6. This is from requirement 1.6. That's where the amount will come from. Then after we have inventory, I took the amount of the inventory as it is, plus trade receivables of 425 and 185,000 rands of the inventory. There we have the trading stock 185,000 rands. We have the bank 75,000 rands. We have trade receivables 425,000 rands. So I took the amount as they are in the real balance because I know that there's a probability of the adjustments, and I also know that there was a fixed deposit or fixed investment, and that fixed investment was an amount of 185,000 rands from the trial balance. So now let us just confirm that. There we have a fixed deposit of 10%. There is 185,000 rands, and also there is no adjustment with regard to this. There was no additional investment and there was no withdrawal of the investment. So hence I just wrote that straight as it is. This amount of the equity will come from the statement of changes in equity here. It will be taken from here. So now I will record that immediately when I am done. Bank is 75,000 rands. There might be an adjustment, so hence I open brackets for that. And after that we have this amount in the trade and other payables. Let me erase this. I'll just show you where it comes from. So I have this amount of trade and other payables, and the amount of trade and other payables is coming from the trial balance. There is the amount of trade and other payables 320,000 rands. So I just took the amount as they are from the trial balance. Then now I know that all the template of what is required in terms of the financial statements and the ledger accounts is already there. So now when I go to the adjustments or to the additional information, I can just flow and record everything as it is, as I read each and every transaction. So now remember, I told you that I will start with the requirements being requirement 1.2, then I'll do requirement 1.6. Don't forget that. Don't want you to be lost and say what say is doing now. I will start with the requirement 1.2, then I will do this, then I will do 1.6 after 1.2, and I said that under 1.2 I will add the cost of the asset that was disposed, being vehicles. So I will have the ledger account for vehicles. I will do after accumulated depreciation, then after I will do the asset disposal. Then from there I can transfer that information to the property, plant and equipment, obviously also taking into account the asset that was not sold, which is equipment in this case. You will see that in the trial balance. So now I can shoot straight to the additional information and record everything as it occurs. So now under A, it says provide for the depreciation on equipment for the current financial year that ends 31st December 2012. That means depreciation for equipment for the current financial year was not yet recorded. So now we have to record that in the property, plant and equipment note, and also record that in the income statement. So now let us just show workings for the equipment depreciation for the current year. Then I say depreciation, and this is the depreciation on equipment only for the current year. And we know that the depreciation on equipment is calculated in the following manner. They say the equipment which with a cost as listed in the pre-adjustment trial balance above was purchased on the 1st of January 2011. Remember, this is the beginning of the accounting period, and has an expected residual value of 75,000 rands. And they say equipment depreciated 20% per annum on the diminishing balance method. The minute the assets are depreciated 20% per annum using a diminishing balance method, in fact, the minute the method of calculating depreciation is diminishing, the residual value is no longer applicable. So you can just cross that one out. It is just there to confuse you. We don't use the residual value whenever we are calculating depreciation using a diminishing balance method, because we know that the method or the principle says cost minus accumulated depreciation. So we don't need residual value in this case. So now we know that is 20%. Let us go to the trial balance and we check how much is the cost and how much is the accumulated depreciation for our equipment. So now if we look at the equipment, the cost of the equipment is given cost minus accumulated depreciation for equipment. The cost of the equipment is given to be 200,000 rands, and the accumulated depreciation is given to be 40,000 rands. Therefore, now the depreciable amount will be 160,000 rands, and we know that it is calculated using 20% per annum, and this equipment was there until the end of the year. Therefore, now the depreciation for the current year on equipment will give us an amount of 32,000 rands for the current year. So now this will be recorded in the income statement, and it will also be recorded in the statement in the property, plant and equipment note. We can just immediately record that in all those statements where it is recorded. So now in the income statement we have our depreciation for the equipment as 32,000 rands, and we also know that in the note, under the depreciation in the note here, we have the depreciation in the note, and we are under equipment. This is where we are in the column of equipment. So now we can record that in equipment as negative 32,000 rands, because this is the movements during the year. Movements is all the transactions that occur during the year. with regard to depreciation, the disposal of the asset, and the buying of the asset. So now we have the depreciation already for the vehicles that was required to be provided. And we have recorded this in the income statement and in the property, plant, and equipment note. So now that was just the first requirement or the first adjustment. Remember, we're not required to do general entry. We just have to provide for depreciation in the income statement, and we're provided as instructed. Therefore, now I am doing number B. Number B says included in the account of vehicles cost as per the pre-adjustmental balance above are the cost prices of both vehicle A and vehicle B. Vehicle A and vehicle B were both purchased and put into use for the first time on the 1st of January 2009. That means both motor vehicle A and motor vehicle B were bought on the same day, being the 1st of January 2009. Remember, the accounting period ends in December. That means it starts in January each and every year. That means these two vehicles were bought at the beginning of the year 2009. And both vehicles have a useful life of 5 years. This is their useful life. Motor vehicle A and motor vehicle B are costing 250,000 rands and 300,000 rands respectively, and 50,000 rands and 75,000 rands respectively for motor vehicle A and B. The following transactions still have to be recorded for the vehicles. Remember, here they are just telling us about the information necessary for us to calculate depreciation and the history of the assets. So now they're telling us now under the second paragraph that the following transactions must still recorded for vehicles. Depreciation on vehicles for the current financial year end 31st of December 2012 has not yet been provided. That means also depreciation for these assets has not yet been calculated. PAL Traders depreciates all vehicles by means of straight line method. So this is a straight line where we say cost minus accumulated depreciation, and we are given all the cost of the assets and their accumulated depreciation. Then after, the second bullet point says that on the 31st of December 2012, vehicle B was traded in for 90,000 rands. A new vehicle, being vehicle C, was received. The cost of the new vehicle, being vehicle C, is 450,000 rands, and vehicle C has an expected useful life of 5 years and the residual value of 100,000 rands. Now remember the date, or take note of the date of the occurrence of this transaction. On the 31st of December 2012. Remember, 31st of December is the end of the current accounting period. It means at the end of the year, motor vehicle B was sold. And remember that motor vehicle B was bought on the 1st of January 2009. That means motor vehicle B was in the business from the year 2009, 2010, 2011, and the end of 2012. Therefore, now the depreciation for motor vehicle B will be calculated up to 4 years, so that we remove that from the books of the business. So they told us that motor vehicle A was traded in for 90,000 rands. That means we gave away motor vehicle B for 90,000 rands. So if we gave away motor vehicle B for 90,000 rands and we received motor vehicle C costing 450,000 rands, it means the difference was supposed to be paid. Let me just show you the calculations here. Motor vehicle C is costing 450,000 rands, and we gave away motor vehicle A with a value of 90,000 rands, and the difference becomes 360,000 rands. So now it means the company must still pay the amount of 360,000 rands, because the value of motor vehicle B was 90,000 rands, but the value or the cost of motor vehicle A was 450,000 rands. So now this amount of 360,000 rands will be recorded as a liability because the company has not paid this amount. So now, because the company has not yet paid this amount, it becomes a liability. And any liability must be recorded in the statement of financial position. So hence, I will immediately record the 360,000 rands under the liabilities in the statement of financial position under trade and other payables. I say plus 360,000 rands because this amount has not yet been paid by the business. They receive an asset costing 450,000 rands, but they only gave away the value of 90,000 rands. So now 360,000 rands is the liability to the business. So now I have accounted for that and it's been accurately recorded. So now we have to record this disposal in their respective ledger accounts because this was a disposal of the asset. Remember, the cost of motor vehicle B, which is the vehicle that was disposed, is 300,000 rands. So now let us go to our ledger accounts. We start opening the ledger account for our vehicles. Then we record that information. Starting with the balance, we have to go to the trial balance, check the opening balance of the cost of our vehicles. And the opening balance of the cost of our vehicles is already given to be 550,000 rands, of which that 550,000 rands is the sum of the two costs of the assets. These two 300,000 rands plus 250,000 rands will give you 550,000 rands. So that's where that opening balance comes from. We start recording the opening balance of 550,000 rands. Then we know that motor vehicle B, that is costing, or that costed the company 300,000 rands, was disposed. So now we must remove the cost of this asset from the books of the business. Therefore now the contra entry under the asset will be asset disposal, where we record the cost of the asset that was disposed being an amount of 300,000 rands, only the cost of the asset that was disposed. Then after we check again, remember this asset was traded in for an amount of 90,000 rands. The amount in which the asset is traded in, or the amount in which the asset has been sold, will go to the asset disposal. This is not the cost, but is the asset disposal amount. The value, asset disposal, the value or the price in which the asset was traded in or sold will go to the asset disposal. But in the ledger account for the asset that was disposed or traded in, we record the cost because the cost was included in that opening balance, as I have shown you that the 550,000 rands is the sum of the two vehicles, being 250,000 rands plus 300,000. The sum of the two vehicles is the opening balance of 550,000 rands. So now it means this vehicle costing 200,000 rands is already included in that opening balance. So when we remove that in the books of the business, we remove it at the cost price, reducing the debit side. Then after, there was a motor vehicle that was received, which is motor vehicle C, 450,000 rands. And it was not bought for cash because we still owe that difference. Then we say creditor 450,000 rands. Therefore now from here we can just have our balance of 1 million rands, 1 million rands, because there was no asset that was disposed beside motor vehicle B. Then after, our balance carried down will be 700,000 rands. Balance carried down will be 700,000 rands, and the balance brought down will be 700,000 rands. Remember, this is just my workings. This ledger account is not required. This is just my workings. But it is important because when I do the PPE note, I will know what is the opening balance, what are the movements during the year, and what is the closing balance. I don't have to hassle for that. Then after the minute you are done with the asset ledger account, then you can go to the accumulated depreciation ledger account. Start with the opening balance once again, and we are given an opening balance for the accumulated depreciation on motor vehicles. And the opening balance for accumulated depreciation on motor vehicles is given to be 225,000 rands. It's on the first day of January 2012. That shows that it is definitely an opening balance. So now we record that 255,000, yes, 255,000 rands. We record that as an opening balance. Remember that 255,000 rands is the total of all the depreciations for motor vehicle A and vehicle B from the date that they were bought until the end of the year 2011, and that became an opening balance. So now we need to account for the depreciation for the current year, because we were told that depreciation for the current year on vehicles has not yet been accounted for. Now we are checking the date in which this asset was disposed so that we count the number of months where necessary. It said in the second bullet point that on the 31st of December, that means the end of the current accounting period, vehicle B was traded in. That means motor vehicle B was there for the full current year, because this is the end of December in the current year 2012, and this is the end of our accounting period. It means vehicle B was there for the full year. Obviously, motor vehicle A was also there for the full year, because motor vehicle A was not sold. Therefore, now the depreciation for this asset must be calculated for the full year, and the depreciation for motor vehicle B must be calculated for the full year. However, motor vehicle C was received on the last day of the accounting period. We received motor vehicle C, 31st December 2012, which is the end of the current accounting period. Therefore, now if that is the case, it means we do not record the depreciation for the asset that was bought at the end of the current year. So now let us calculate the depreciation for motor vehicle A and the depreciation for motor vehicle B. So now let us just do that calculation. Motor vehicle A, we know that it is costing for 250,000 rands. Cost of motor vehicle A is 250, vehicle A. Then we say depreciation for vehicle A is the cost of 250,000 rands minus the residual value. We are given the residual value as 50,000 rands minus 50,000 rands. Then that will give us 200,000 rands. And if you say 200,000 rands, we divide that by the useful life of 5 years. 200,000 rands divided by 5 years will give us depreciation for the full current year as 40,000 rands for motor vehicle A. Therefore, now for vehicle B depreciation for the full year, we use the same method, because they told us that it is both straight line method in vehicles A and B. So now the cost of motor vehicle B, which is the vehicle that was sold, was 300,000 rands, and the residual value was 75,000 rands. Therefore, now if we say 300,000 rands, we minus 75,000 rands, that will give us 225,000 rands as the depreciable amount. Then we divide once again by the useful life of the asset being 5 years. That will give us 45,000 rands. Remember, this is the depreciation per annum or for the full year, and this is the depreciation per annum or for the full year, because both of these vehicles were in the business until the end of the current accounting period. So now it means we have two depreciations: 40,000 rands for motor vehicle A that was not sold, and 45,000 rands for motor vehicle B that was sold at the end of the current year. So now we can smoothly go and record the depreciation for the current year. and the depreciation for the current year will be a sum of 40,000 rands plus 45,000 rands, and that will give us 85,000 rands as the depreciation for the current accounting period. The third step when you are doing this ledger account is to remove all the total depreciation for the asset that has been sold or traded in. And in this case, we know that motor vehicle B that was costing 300,000 rands was traded in at the end of the current year. And we were told that motor vehicles, both A and B, were bought on the 1st of January in the year 2009. That means motor vehicle B was there in the year 2009, 10, 11, 12. It means we need depreciation for the full 4 years for motor vehicle B. Then we remove all of that on the debit side of the accumulated depreciation. So now let me just recalculate my total depreciation for motor vehicle B from the year this asset was bought up to the year this asset was disposed. So now we know that motor vehicle B was bought at the beginning of the year 2009. So I'm just restarting vehicle B. In the year 2009, motor vehicle was bought and the cost was 300,000 rands, and we set minus 75,000 rands. That gave us 225,000 rands. We divided by the useful life, and that gave us 45,000 rands, which is depreciation for the year 2009 when the asset was sold. Therefore, now in the year 2010, remember motor vehicle B was still in the business. Therefore, now depreciation will be the same 45,000 rands because this depreciation is for the full year and the asset was there for the full year 2010. It was not sold. Hence, they told us that it was sold in the year 2012. So now in the year 2011, again, this asset was in the business for the full year. So now the depreciation still remains the same. Same method, 300,000 rands minus 75 is equal to 225,000 rands. Divide by 5 years, you get 45,000 rands. There is no need for us to repeat that. Now in the year 2012, we know that this asset was sold at the end of December. That means it was there for the full year 2012. It means now the depreciation in total for motor vehicle B up to the date the asset was sold is 45,000 rands times by 4 years. That means it's 45,000 for 4 years. Therefore, now it means the total accumulated depreciation for the traded in vehicle being vehicle B, total accumulated will be an amount of 180,000 rands. So now if we need to calculate the carrying amount, just to go a little bit further, carrying amount is equal to the cost, and the cost is 300,000 rands minus 180,000 rands being accumulated depreciation. We are calculating now the carrying amount when the asset, on the date the asset was sold. So now we say 300,000 rands minus 180,000 rands. That will give us the value of the asset as 120,000 rands. So now this is the value of the asset on the date the asset was sold. So now let us record the 180,000 rands. This is the one that we are recording in the ledger account. Total accumulated depreciation that must be removed on the debit side of the accumulated depreciation ledger account. Just to save that. So now we can go to the accumulated depreciation ledger account and we record the 180,000 rands being the total depreciation, and the contra entry will be asset disposal, because we are doing all of this because an asset was disposed. Then after you are done with that, you can balance the ledger account for the accumulated depreciation, because we are honestly done with that. So now let us give the total of the accumulated depreciation. Then we say 255,000 rands plus 85,000 rands. That will give us 340,000 rands. 340,000 rands. We subtract the debit side being 180,000 rands. That will give us 160,000 rands as the balance at the end of 2012. Balance carried down, and balance carried down will be balance brought down. Then we say balance brought down. And from this stage, it means now we have covered this. We have covered this ledger account completely. Therefore, now we can continue do the asset disposal for this asset that was disposed, motor vehicle B. Then we scroll down. Remember, on the debit side of the asset disposal, you record the cost of the asset that was sold, and the asset that was sold is motor vehicle B, and the cost of that is 300,000 rands. So now we know that for every debit entry there must be a credit entry. Asset disposal is credited under the vehicle account, therefore now it must be debited in its ledger account, and the cost of that is 300,000 rands. Contra entry will be vehicle. Then after, there was a total accumulated depreciation for the asset that was disposed that amounted to 180,000 rands. There on the debit side of the asset disposal, we record that on the credit side always it does not change, 180,000 rands. Contra entry is the name of the ledger account it comes from. Accumulated depreciation on vehicles. Then after, we have to record the price or the value by which an asset was disposed, and we know that the value by which motor vehicle B was disposed was 90,000 rands, because they told us that motor vehicle B was traded in for 90,000 rands. So now that was the value of the disposed asset, and the value of the price by which the asset was disposed is always recorded on the credit side of the asset disposal. You see that where I'm underlining 90,000 rands. They said on the 31st of December 2012, vehicle B was traded in for 90,000 rands for a new vehicle being vehicle C. So now this is the value or the price at which vehicle B was traded in, and that value is the one that must be recorded on the credit side of the asset disposal. Remember, if this asset was sold and it was sold for cash, if let us say they sold it for 90,000 for cash, therefore now the contra entry was going to be bank, but it was not sold for cash, it was traded in, therefore now we write creditors. So from here we have recorded all that was necessary. Then we can just identify if have we made a loss or a profit on the sale of this asset. Let us just come to my workings, because I like to use this approach. Remember, we have the carrying amount here at the bottom. Carrying amount of this vehicle by the end of December is 120,000 rands. But we gave away for this asset at the value of 90,000 rands instead of its value of 120,000 rands. We gave away with it at the value of 90,000 rands. It obviously means that 120 minus 90,000 rands will give us a loss of 30,000 rands. Therefore now, hence we have a loss of 30,000 rands. So now that amount of the loss will be recorded under the asset disposal on the credit side as 30,000 rands. This will be a loss on disposal. This will be a loss on disposal. And immediately when you get a loss or a profit on the disposal of the asset, record that instantly in your income statement, because if you don't do that, you might probably forget that. So I've already made a provision for the loss on the disposal, then I can record that as 30,000 30,000 rands. Please don't forget that. With regard to depreciation, once again, we have already completed that, and we can record it too if we want so. In the accumulated depreciation for vehicles, we have a total depreciation for the current year of 85,000 rands. That means we can immediately also record that in the income statement, because we have already accounted for the one on equipment. We add 85,000 rands. And these are the only two assets that were depreciable. Therefore, now we have recorded their sum, and the total will be 117,000 rands. So now we know that depreciation has been captured, disposal loss has been captured completely. So now let us continue with the requirements and we see how far we are. So now the ledger account is complete. We can just write the total of 300,000 rands, the total of 300,000 rands. Remember, when you add your credit side, it must be equal to your debit side, or else to calculate this loss of 30,000 rands, you can just say 300,000 rands minus 180,000 rands minus 90,000 rands. That will give you 30,000 rands. And if you see the credit side, the debit side of 200,000 rands is greater than the sum of the two of the credit side. So now when you get that 30,000 rands, you know that it goes straight to the credit side. So that's another approach you can calculate your loss. 200,000 rands minus 180 minus 90,000 rands, you get 30,000 rands on the credit side as the loss on the disposal of this asset. So now from here we can do the property, plant and equipment note, starting from the asset section of that. So now from equipment, start with the equipment. Equipment, we were not told of any disposal or either any purchases. So now the opening balance of equipment is given there as 200,000 rands. And since there was no purchase of equipment, opening balance becomes the closing balance. So now the cost at the opening will be 200,000 rands and the cost at the closing will be 200,000 rands. Then after we write the opening balance of the accumulated depreciation. Opening balance of the accumulated depreciation on equipment is given to be 40,000 rands. So we write that opening balance as 40,000 rands. Make sure that it is negative 40,000 rands. Remember, there was no purchase of any equipment during the year, and there was also no disposal of equipment during the year. And whenever that is the case, you just say opening accumulated depreciation, you add your depreciation during the year, that will give you the closing accumulated depreciation at the end of the current accounting period with regard to equipment. So now we have to say 40,000 rands plus 32,000 rands. That will give us an amount of 72,000 rands of the accumulated depreciation at the end of the year. 40,000 rands plus 32 will give us 72,000 rands, because there was no purchase of equipment, either a disposal of equipment during the year, so it just becomes easy like that. So now it means the carrying amount at the end of the year with regard to equipment, it will be just 200,000 rands minus 72,000 rands. That will give us 128,000 rands as the carrying amount at the end of the year. Remember, when you say 160,000 rands plus, 160,000 rands minus, not plus, if you say 160 minus this, it should give you the same 128,000 rands. 160,000 rands minus 32,000 rands does give us 128,000 rands, just to confirm the accuracy of your amounts. Then after we go to the second column, being our vehicles, we will just be using the ledger accounts in this case because our ledger accounts have completed everything. In the ledger account, there is an opening balance for vehicles, and the opening balance is 550,000 rands. That opening balance must exactly be the same as that which appear in the note, 550,000 rands, because this is the opening balance on the 1st of January in the year 2012. This is an opening balance. And we have to record the opening accumulated depreciation, and the opening accumulated depreciation balance is 255,000 rands. So we record that 255,000 rands. And if you strike the difference between the two, that will give you the carrying amount at the beginning of the accounting period, and that will be an amount of 295,000 rands. 295,000 rands. Then after we come to the section of the movements. Remember, in the movements you have acquisitions, which are normally called the purchases, and the disposal at carrying value. Take note of that. Disposal at carrying value. That means you are recording the asset that you have disposed at carrying value. And after we record depreciation for the current year. Remember, with regard to equipment, there was no purchase during the year. There was no selling of asset during the year. So hence we skip that as blank. So now we come to vehicles, and we know that there was a new vehicle that was bought during the year. And the vehicle that was bought during the year was costing 450,000 rands. Yes, 450,000 rands. And in the adjustment, it also agree with us that motor vehicle C was received. Motor vehicle C was received, and the cost of vehicle C was 450,000 rands. And it was on the 31st of December 2012 at the end of the current accounting period. So now we record the purchases of the asset at cost. So it will have to be recorded at 450,000 rands. Then the disposal or the selling of asset must be recorded at carrying value. And I have calculated the carrying value for the asset being motor vehicle B that was disposed or traded in. There is the carrying value. See it, that 120,000 rands, where we said the cost of 200,000 rands minus 180,000 rands of the total accumulated depreciation until the end of the year. That gave us the carrying value of 120,000 rands. So now we record the disposal at carrying value, which is cost minus accumulated depreciation. And it must always be negative because we have sold the asset, we are removing it out of the books. Then after, we have to record the depreciation for the current year, and the depreciation for the current year was recorded to be 85,000 rands, both vehicle A and vehicle B. So now we record that 85,000 rands as negative. Then after, that will bring us to the carrying value and the cost at the end of the year. So now the cost at the end of the year is also from the ledger account. Here is the balance of the cost of the asset end of the year, 700,000 rands. It was brought beginning of the following year. So now that is the closing balance. We record that cost at the end is 700,000 rands. And accumulated depreciation at the end of the year, there we have balance carried down of the accumulated depreciation, and that balance was brought down beginning of next year, 160,000 rands. Therefore, now we take that 160,000 rands as the closing balance of the accumulated depreciation, and the carrying value at the end of the year will be 540,000 rands. And with that being said, therefore now we can just totalize or give the total for the total column. And with regard to the cost, we have the cost. Okay, the cost is a total of 750,000 rands. and the accumulated depreciation is 295,000 rands. The carrying value is 455,000 rands. We have 450,000 rands. We have negative 120,000 rands. We have 117,000 rands. If you see this 117,000 rands is exactly the one that appear in total in the income statement, 117,000 rands in the depreciation. So there is definitely a link when we come to our calculations. Then after we have carrying value at the end of the year being 600, carrying value 688,000 rands. Remember, this amount is the one that go to the statement of financial position. Then we have the cost at the end of the year being 900,000 rands, and we have the total accumulated of 232,000 rands at the end of the year. Therefore, now we must take this 688,000 rands and record that immediately in the statement of financial position under the property, plant and equipment, 688,000 rands, and total 688,000 rands. That one is complete and done. So now let us go to all other adjustments now, because we have completed adjustment A, we have completed adjustment B, and both of them have been recorded where they belong and all the amounts in their respective financial statements. Now number C says a debtor Mr. B bankrupt, which means bankrupt, who owes 25,000 rands was declared insolvent during the financial year. Therefore, now this debtor owed us 25,000 rands, and on the 31st of December 2012, which is the end of the accounting period, a final dividend of 20 cents. Remember, 20 cents is the same as 20% in the rand was received by Pearl Daisy Traders. The balance on his account must be written off. That means only 20 cents or 25% more was received. The rest will be a bad debt. So now it means out of the 25,000 rands that the debtor owed us, we times that by 20 cents, which is 20%, that will give us 5,000. 5,000 was received. So now if 5,000 was received, it means 20,000 was not received. So now this money was received, and they are telling us that the balance of his account must be written off as irrecoverable. And look at this last sentence. These entries have not yet been recorded. It means this 5,000 that was received was not yet recorded in the books of the business. So now it has to be recorded as cash in the bank. So let us record that as cash in the bank, which will affect our statement of financial position. So now under our bank, we have to say plus 5,000 rands, because this money was received but not yet recorded. Then we continue again with the transaction. Remember, if 5,000 was received and the rest of the balance must be written off as irrecoverable, it means 20,000 is a bad debt. Therefore, now bad debts are expenses. Then the 20,000 must be recorded in the income statement under our bad debts. We say plus 20,000 rands. Then after we continue with the same adjustment. So now take into account that this 20,000 is no longer a debtor because it has been declared insolvent. The 5,000 is no longer a debtor because we received this money. Whenever the debtor pays us, we cancel the debtor. And whenever the debtor is declared insolvent, then we also cancel that amount from our debtors. So now it means the full 25,000 rands that the debtor owed us is no longer a debtor in the business. It means this amount must be taken out or removed from the debtors of the business. So now hence we have to go to our statement of financial position under our trade and other receivables, and we reduce our debtors by the total of 25,000 rands, because another portion was received and another portion was declared to be never received. Therefore, for that reason, we subtract our trade receivables by 25,000 rands, because this amount was still inside our total debtors. Then we subtract the full 25,000 rands. I hope you are very clear with that, because students sometimes get to be confused with that. Then the next sentence says that, so remember now we have recorded this 20,000 of that as a bad debt, 5,000 of that as cash in the bank, and the full 25,000 rands has been removed from the books of the business. Now the second sentence under number C says, it was decided to adjust the allowance for credit losses of the outstanding. Take note of that, outstanding trade receivables. The reason why they say outstanding, they are trying to tell you that please remove that 25,000 rands from the debtors before you calculate the 6%, because 25,000 rands is no longer a debtor. 5,000 was received, 20,000 was declared to be irrecoverable, never to be received. Therefore, now for that reason, we have to first subtract the full 25,000 rands from our debtors before we calculate the allowance of 6%. Before we calculate the allowance of 6% of the outstanding debtors. So now let us go and check the amount of our trade and other receivables in the statement of financial position. So now in the statement of financial position, we see that our trade and other receivables, they amount to 425,000 rands. Remember, 25,000 rands of the debtor that was declared insolvent and paid 20 cents in the rent is still inside there. So now we first have to remove that, and we say 425,000 rands minus 25,000 rands will give us 400,000 rands, and we multiply that by 6%, it will give us 24,000 rands. So now this is the allowance that we have calculated for the year. And if you see that this allowance of 24,000 rands is above the allowance that was already calculated last year, it was closing balance last year, became an opening balance. But the allowance of 10,000 was already recorded. There is 10,000 of the allowance that was already recorded. But the correct and accurate allowance is 24,000 rands. However, 10,000 has already been recorded. So now it means we have to say 24,000 rands minus 10,000 rands. That will give us 14,000 rands. And the 14,000 rands must be recorded in the income statement as a bad debt. However, the full 24,000 rands that we have calculated must go to the statement of financial position, which is a balance sheet statement. Please don't forget that. The allowance that you calculated at the end of the year, after you have subtracted the bad debt at the end of the current year, you calculate that, you get the amount, which in this case is 24,000 rands. Immediately record that in the balance sheet as a reduction on an amount that will reduce your debtors. Therefore, now minus 24,000 rands. The reason why for that is because we are under the assumption that 24,000 rands of our debtors, or an amount of 24,000 rands from our debtors, will not be paid. So now anything that will not be paid is supposed to be removed from the debtors. So now hence the company removes that. Then we already see that 10,000 was already recorded. Therefore, now in the income statement, we only record 14,000 rands, because this was done, remember, last year. So now the 10,000 was recorded in the income statement of the previous accounting period. So in the income statement, we only record 14,000 rands under the bad debts. So now we go straight to our income statement, and our credit loss we say plus 14,000 rands. Even if you can open a separate line item here and say allowance or adjustment for credit loss, and to separate that, you'll still be correct. Some people prefer that approach. So now we have recorded the 24,000 in the balance sheet, and we have recorded the 14,000 under the income statement. So now we have covered all these two. Then we can continue now with our adjustment once again. So now the adjustment that we dealt with was the adjustment under number C, of which we have done that one and we have done this one. So now we go to number D. Number D tells us that the value of the inventory on hand as per the physical inventory count held on the 31st of December 2012 amounted to 184,000 rands. It means by the end of the current year, when the company did a physical count, which is normally called stock taking, they realized that the value of the inventory that was in the store was 184,000 rands. However, the accounting system captured inventory at the value of 185,000 rands. That means now the inventory in the system is overstated. Therefore, now because of that, we have to say 185,000 rands minus the inventory from the physical count will give us a difference of 1,000 rands. Remember, we always record our inventory using the physical count. In this case, whenever the physical count is lower than the system or what the system says. So now it means our inventory in the accounting record or in the accounting system must be reduced from 185,000 rands by 1,000 rand to 184,000 rands. So now it means our inventory is losing value, is going down from 185 by 1,000 rand, and it has to become 184,000 rands. So now let us first record that straight in the balance sheet. Therefore now our inventory must be reduced by an amount of 1,000 rands, so that it becomes what was physical counted 184,000 rands. Then now, not to forget the fact that our inventory has lost its value, which is normally called inventory deficit or inventory loss. Therefore now our inventory loss will be the amount of 1,000 rand, and inventory loss is an expense. So now the inventory loss will appear in the income statement under the expenses as inventory loss or inventory write down, and I have already made a provision for that inventory deficit by an amount of 1,000 rand. And please take into account that inventory write down or inventory loss can also be recorded as a plus in the cost of sales. Even if you take that 1,000 you record under the cost of sales as a plus, you still be 100% correct, because inventory write down must increase the cost of sales to reflect the original amount of the cost, which was 185,000 rands. So you still be right if you do that, but I will just focus on one dimension. So now we have captured that, and we can go to, we have recorded under asset and we have recorded under the income statement. Now the one before the last is number E. Number E tells us that insurance expense include an amount of 7,500, which represent the insurance for January 2013. So now it means this insurance was paid for next year, but at the end of the current year. So now this becomes a prepaid expense, and a prepaid expense is an asset. Anything that is paid before time by the end of the year is an asset. So now this prepaid expense is an asset. Therefore now any prepaid expense or any asset must affect the statement of financial position, and it has to affect our trade and other receivables positively. Then we have to say plus 7,500. Then after, we also have to take that into account in the ledger account for insurance. Remember, this 7,500 is included in the amount of insurance that is in the trial balance. So now it means the insurance sitting in the trial balance as 84,500 is overstated, because 7,500 does not belong in the current year, it belongs next year. So now hence this 7,500 must be removed. So now let me also go and check the ledger account for insurance that was required, because I think there was requirement 1.1 that required us to do the insurance expense account. So now here the insurance expense account, we first have to start with the total that come from the trial balance. The total from the trial balance of insurance, I think, is 84,500 rands. Yes, 84,500 is the total from the trial balance, 84,500. Then we have prepaid by the end of the year, prepaid of 7,500. Remember, we are removing this amount from the debit side to the credit side to the asset account, because it is not an expense at the end of the year, it is an asset. So now we can't be increasing our expenses on the debit side, but reduce them so that we only have expenses for the year. And once again, there was an insurance, and always make sure that you check for the accruals opening balance. If was there any opening balance of the accrual, make a reversal for that. Remember, this insurance was paid last year, it was paid for the current year, it was a prepayment of last year, but in the current year now it was no longer prepaid. Therefore now we have to recognize it as an expense in the current year. So now do you see, now a prepaid expense from last year is debited, but a prepaid expense at the end of the year is credited. So please take note of that. So now this is prepaid, you can say in brackets reversal. So this is prepaid last year, reversal. This is prepaid at the end of the year for next year, always on the credit side. Just keep that principle. I think it will just simplify things for you. So now the total of the debit side is 91,500 and 91,500, and the difference will be 84,000 rands, and the difference is the one that goes to profit and loss. So now this will be the total in the income statement. So now in our income statement, it means we have to record another insurance. If you want, you can say, okay, reversal of an expense from last year is a plus, reversal of the prepaid expense, and prepaid expense at the end of the current year is 7,500. So now you say plus the prepaid of last year, and you say minus prepaid at the end of the current year. That will give us the same 84,000 rands as it appears in the ledger account. So now we have captured almost all the adjustments that were required of us in this question paper. Let me confirm. Okay, the last one now is number F. We have recorded this as an asset. We have recorded this also in the ledger account, reducing our insurance. Then we go to number F. Number F says it was determined that outstanding interest on the fixed deposit on the 31st of December 2012 has yet to be provided for in the books. The fixed deposit will mature, look at that, it will mature when on the 30th of June 2013. Remember, we are doing the books for the year end 31st December 2012. Now from here until 30th of June 2013, it is just 6 months. So if this is 6 months, it indicates that this fixed deposit will mature in the next 6 months. And if it matures in the next 6 months, that means it is less than a year. So now if it is less than a year, that means the fixed deposit will be a current asset. Therefore, now in the statement of financial position, a fixed deposit will be recorded under the current assets. Hence, I have that fixed deposit, fixed asset, 185,000 rands under the current assets. It is for that reason. The maturity is less than a year, which is in this case just only 6 months. So now we have captured the fixed deposit asset section. Therefore, now we have to capture the interest portion now of the fixed deposit. We know that the fixed deposit is 185,000 rands. So now we have to calculate the interest, although I did this initially. Is 185,000 rands times by 10%. That will give us 18,500. And we said in the trial balance there was 14,000 that was already received. So now if there is 14,000 that was already received, this was already received, and this is what was supposed to be received. Supposed to be received. So we're supposed to receive this amount, but we only received 14,000 by the end of the year. It means the difference of 4,500 is accrued income. And accrued income is an asset because it is income that is not yet received. So now the accrued income of 4,500 will be recorded under the trade and other receivables, increasing our receivables. That means we have to say just there on top plus 4,500. Then we go to the income statement and we record the total. We have already recorded, remember here, 14,000. We just have to say plus 4,500 so that this becomes 18,500. So this is the total interest that was supposed to be received. And remember, from page 53, if I'm not mistaken, page 53 of your textbook, it tells you that in the income statement we record expenses that were supposed to be paid rather than actually paid. And we also record incomes that were supposed to be received rather than what was actually received. Although we received 14,000, but we're supposed to have received 18,500 for the year. So now hence we record that in the income statement as the total income and for the year. So now with that, let us just go and check. Sorry for that. Go and check if is there any other adjustment to take into account. Now all the adjustments are done, and if you have seen my strategy, every time I see an adjustment I record it immediately. First of all, structure everything, have your template completed. Therefore now, since I am done with all the adjustments and I'm very confident that I've recorded and captured them where they're supposed to be recorded, it means I can just go and totalize all my amounts. Then now I have to see what is to be balanced. So now starting now to the income statement, just completing everything. Therefore now my sales revenue from the trial balance, I'll just be using mostly the trial balance now. From the trial balance I have an amount of sales which is 3,600,000 rands. There is 3,600,000 rands is the amount of my sales. 3,600,000 rands. The amount of the cost of sales is given to be the amount there. We have our cost of sales 2,300,000 rands. Cost of sales is 2,300,000 rands. And if you say sales minus cost of sales, you get to the gross profit of 1,300,000 rands. Then now we have to, okay, our interest is already there. Our expenses, I need the total of all my expenses. And if you add all your expenses, as you can see them, 2.5 plus 20,000 plus 14,000 rands, that will give us an amount of or my credit loss will give us an amount of 22,000 credit losses will give us an amount of 22,500 plus 14,000 plus 14,000. That will give us 36,500. Then we have our wages, and there was no adjustment regarding wages. We record that as it is. Rent, there was no adjustment, just record the 60,000. All other expenses have been accounted for. So now we can just totalize all the expenses, and the total of all the expenses, it will give you 943,500. 943,500. Then after, we just have to say now gross profit plus interest income minus total expenses. That will give us profit for the year as 375,000 rands. That will be the profit for the year. And the profit for the year of 375,000 rands must be recorded in the statement of changes in equity as 375,000 rands. As it is, you don't change that. And you get a method mark for that. Even if this amount is wrong, this profit, even if it's wrong, but if you transfer here as it is, you get a method mark. Please don't forget such giveaway marks. Then after, we have to record the opening balance. Normally it will be the amount of the capital or retained earnings where there are retained earnings. Capital is 650,000 rands. Then we record that capital as 650,000 rands opening balance. 650,000 rands. The amount of drawings, remember there was no adjustment with regard to drawings. If there was an adjustment, therefore now you'll have to take the adjustment into account. So now the drawings that were already recorded in the trial balance was 200,000 rands. Therefore now we record that as 200,000 rands. Then the total or the closing balance in the statement of changes in equity will be 825,000 rands. 825,000 rands. Then this amount will go straight as it is in the statement of financial position. 825,000 rands. Even if it is wrong, record it there, 825,000 rands. You will get a full method mark for that. Even if it's incorrect, even if you are confident that is wrong, but transfer it, you get a method mark for that. And I always emphasize that. Let us just start with our liabilities. Here at the bottom we have 680,000 rands. These are our current liabilities. Total is 680,000 rands. The sum of all three, all two, 680,000 rands. There was no non-current liability. Then after, we have to add our current liabilities plus the equity. That will give us a total of equity and liability 1505000. Then our bank account is 80,000 rands. Our total trade and other receivables will give us an amount of just adding the amounts, 388,000 rands. 388,000 rands. Then after, our inventory is 184,000 rands. Let me just write that on top. 388,000 rands. Then adding the sum of the four amounts will give us total current assets, and the total current assets is 184 plus 388,000 rands plus 185,000 rands plus bank of 80,000 rands. That will give us 837,000 rands. Therefore, now we add our current assets to the PPE non-current assets. That will give us the total of 1505300. And from there, our balance sheet does definitely balance. Therefore, now with that, I have completed this question paper. However, it is still very important for students to understand the definition of assets. 1.7, you were required to define an asset and recognize an asset. Don't forget that an asset, in this case being equipment, because you are required to define an equipment. An asset is a resource controlled by the entity due to past events which will lead to future inflow of economic benefits. That is the definition of an asset. The recognition criteria of an asset, it says the cost of value is reliably measured. Then the second one, there must be a probably inflow of economic benefits, or inflow of economic benefits are probably. With the ratios 1.8, we'll do that in the second term. On my side, thank you, all the best. And if you have any further questions, please consult me. Thank you.